It is well known by now that members of Congress typically outperform the market, something we've seen in 2024, but pretty much as far back as the data does go, we can see that consistent trend that members of Congress not only outperform, but by quite a significant distance, and that is why in today's episode we are highlighting some of their latest purchases, so we too can outperform and understand what are the stocks they have been adding to their portfolio. And what we've effectively done is gone through each one of these, especially in the more recent period, including Nancy Pelosi as well as many others that have outperformed at least over the last few years, to understand what they're buying. And whilst we have this information to be able to do so, this may not be something we can do moving forwards, as Donald Trump said when asked if he would ban congressional stock trading that he would absolutely be willing to do this, something perhaps that Nancy Pelosi herself doesn't like to hear, and they've gone as far as naming the act to ban Congress from trading stocks after her as the Pelosi Act, in which they say members of Congress should be fighting for the people they were elected to serve and not day trading at the expense of their constitutions. And this, if it does come through, would effectively ban lawmakers, their spouses, who also typically outperform quite significantly, from holding, purchasing or selling any individual stocks for the duration of the time that they are in office. And why this is something again that we do want to highlight in today's episode, because not only do they outperform, but by quite a significant distance. For example, if we take a look at Nancy Pelosi's portfolio, if we go back to around 10 years ago today, since then the S&P is up over 200%. Her own portfolio is up more than 700, so that is why today we want to see what are they buying, and we'll also give you our own opinion. Now, there are 12 stocks that we have noticed many of them have been adding to their portfolio. We're going to run through them very briefly, give you our own perspective on the valuation if we see there is some nice upside, a margin of safety. Starting off with Big Pharma, Novo Nordisk. Now, this one has been plummeted 44% over the last year. Year to date, down 20%, about 1/5 of their market cap just wiped out in a matter of months, and over the last 10 years, even with the drop, they still have managed to outperform the S&P, up 146%. Trading near their 52-week low, massive pullback from their 52-week high near $150. Not only are members of Congress adding, but both Seeking Alpha and Wall Street do believe this is a buy, and we'll also highlight it is currently trading at a valuation of 17.1, not only significantly below the 5-year of 30.4, but one of the lowest they have been trading over the last 5 years, a severe undervaluation signal, coupled with the fact the yield on offer of 2.34 is well above the 5-year of 1.41, does give us today two severe signals that NVO is undervalued. And just to reinforce this, when we do take a look at this model, which is based on the 5-year average PE, the blue tunnel, in fact the expected intrinsic price, we can see massive disparity between where the company sits and even the bottom end of the blue tunnel, one which has only been getting larger and larger in 2025. So based on these three models, it does look like potentially we have a severe undervalued company. And they're also growing at a fairly attractive rate, a B+ overall, year-on-year revenue up 25%, forward-looking 21%, well above the sector at 7 and 8% respectively, but also growing faster than their own 5-year average at 18 and 15%, whilst anticipating EPS to grow at 16.4 over the next 3 to 5 years, well above the sector at 10.5, but also above their own 5-year at 14.6. We also notice the company anticipates over the next 4 quarters, so for all of 2025, double-digit growth to the EPS, with a 75% track record. 3 out of the last 4 quarters have been beats against analyst targets, and they're trading at next year's numbers at a forward valuation of 14.3 for those that do want to see their next full accounting period estimate. Now, as we said, we'll also give you our own perspective on their valuation, where we believe the intrinsic price to be $101, derived from the DCF model. Now, we'll highlight here we have the free cash flow year on year, average growth around 10% over the last 10. We've got around analyst target at 14% moving forwards, but bear in mind we have a low, medium and high, 12, 14, 16% respectively, and these numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running to your own numbers, whether it's for NVO or any others. But based on the growth rate and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 101, indicating 46% upside. We'll also highlight for those that believe it should be lower at 12%, $87, indicating 26, and for those that are a lot more bullish on the company, 16%, 116, 68% upside. Now, as typical on this channel, we will take through the median rate at 14% because we're not just done there. We always add an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $91, then we keep going till it's near the current trading price, and effectively for NVO in today's episode, we're saying it has a 30% MOS. Wall Street themselves, we got the buy rating $95 over the next year, in turn translating to 38% upside. This is one stock many of them have been adding, 30% MOS, 38% upside. In your own opinion, do you see this as a buy, hold, or sell? And we'll also highlight for those that believe it should be lower at the 12% rate that you are still getting, in fact, a margin of safety. And as we keep going, you're getting bang on 20% with, as we said, 38% upside. And we'll go one step even further in today's episode at a 10% growth rate. Whilst you are getting a margin of safety, it is around the 5 to 10% mark. So it will depend on what your expectations are moving forwards. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to a recently released copy of stocks that are severely undervalued for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as another recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to stock number 2 that they have been adding, BMO, Bank of Montreal, up 9% over the last year. Year to date, pretty much flat. Over the last 10 years, up around 51%. Bear in mind, this is if you had added 10 years ago, but we can in fact notice if you added around the COVID drop, it was around the $43 mark, you would be up more than 2 times, and we can see here all-time highs around $121. Currently though, trading around the mid to upper end of the 52-week range. Quant give this a strong buy, with both Seeking Alpha and Wall Street giving this a buy rating, although we do notice the forward valuation and the current yield on offer aren't too far off the 5-year averages, so you could argue based on this reasonable signal, whereas for NVO previously we did note a severe undervaluation point. And we also notice when taking a look at this model, given it is slightly above at the upper end, we did see above the overvaluation signal, but you could also argue moving around that reasonable to overvaluation point. They get a B- on their growth, revenue year on year around 4%, forward looking around 5%, slightly below the sector at the 6% point, and slightly below their own 5-year averages, whilst they anticipate EPS to grow fairly strongly, 16%, well above the sector at 10%, but also above their own 5-year at 7.2%. And whilst we aren't doing a deeper dive, worth highlighting here on the gradings, B+ on valuation, B- on growth, and an A+ on profitability. And finally, before their own valuation, out of the next 4 quarters, they're anticipating 3 of them to be growth. However, over the last 4, they have missed on 3 of them, only a 25% track record, but at least the most recent quarter was a beat, trading on October 26 numbers at a forward valuation of 10.4. Now, intrinsic value is $115, which is purely the average of these 3 models that you see on screen, all of them as well giving a fairly similar number. Now, in terms of an MOS at 10%, a buy at 103, but in today's episode for BMO, we give this a 15% margin of safety. Wall Street, with their buy signal, see this $110 over the next year, translating to 13% upside. Not one we have covered lately, so let us know your own opinions, whether you see it as a buy, hold, or sell, and perhaps if you would like a deeper dive. We then move on to Apple, stock number 3, which over the last year is up 19%. Year to date, down 18%, nearly 1/5 of this Mag 7 company just wiped straight off in terms of the market cap. And over the last 10 years, they still nonetheless have outperformed the S&P, up 544%. trading towards the lower end of the 52-week range, just one buy rating as well from Wall Street, and we also notice both forward valuation as their yield aren't trading that far off the 5-year average, very similar to BMO, so we do get a reasonable signal, and that's also confirmed when we take a look at this model, pretty much sitting around the midpoint. Growth as well, not looking the greatest, no surprise, feels like it has been a while since we have seen innovation from the company. D overall, revenue year on year and forward looking around the 4 to 5% point, slightly below the sector at 6 and 7% respectively, but also below their own 5-year at 9 and 7%. Worth also highlighting, over the next 3 to 5 years, EPS anticipated of 10%, sector at 14, which is above, and even their own 5-year at 11.2. But we can see green right across the board, something we always like to note. 100% historical track record, some kind of growth expected to the earnings per share as well, trading on September 26 numbers at a forward PE of 26 on the dot. Now intrinsic value gets to $200, and we can in fact see the current price does sit slightly above, so we do believe this company is trading right now at a marginal premium, something some investors are happy and willing to pay for the company. But bear in mind, we have used the lower growth rate today of 8%, something, as we said earlier, we like to use the medium, but for Apple we give it the exception given the fact that we haven't seen a lot of innovation over the last few years and nothing to really warrant that expectation moving forwards. So no margin of safety currently, trading around the reasonable price slash in fact slight premium, and at a 10% MOS it would be a buy at 180, at 15 around 170, and at 20% around 160. But right now we see this no margin of safety, reasonable signal. Wall Street themselves, the only analyst with a buy rating, $235, 15% upside. The next stock members of Congress have been adding is in the semiconductor space. ASML down 21% over the last year. Year to date pretty much flat. Over the last 10 years up 541%, massively outperforming the S&P, trading near their 52-week low, massive pullback from their all-time high $1,110. Both seeking alpha and Wall Street in agreement this company is a buy, and we can also see their forward valuation of 26 severely below the 5-year of 34, so we do get that undervaluation point to note, and their yield, although only marginally, does sit above the 5-year of 0.84, whilst also getting that severe undervaluation signal here, disparity between the bottom end and the current value, although over the last few weeks it has started to rise and get nearer to that reasonable signal. In terms of growth, it does get a C+, but year-on-year revenue at 18% is well above the sector at 6, slightly below their 5-year at 20, with over the next 12 months anticipated 10%. Bearing in mind this industry is fairly cyclical, sector median still lower at 7, and their own 5-year still higher at 16.4. In terms of EPS, 19% expected, above the sector comparative at 14, but it does come in below their own 5-year at 22.4. And finally, over the next 4 quarters, 3 of them expected to be growth, 100% historical track record, trading December 2026 numbers at a forward P of 22.5, and our intrinsic value of just over $1,000 is derived from a growth rate of 14% moving forwards. Now we will show you on the lower rate as well, but taking this medium one first, at 10% a buy at 950, and you can pretty much see this one very similar to NVO. It does have a fairly large margin of safety, around the 35%. Wall Street with their buy rating, $943, anticipated upside of 37%. So some of these we do see quite a large upside, and maybe that is also what members of Congress see, although some people would say they're a bit closer with some insider information. And as we said, if we lower it to 12%, you are still looking at a fairly large MOS, not as much as the higher growth rate, but as we keep on going today, you're getting bang on 25%. And again, we can go even one step further, lower the growth rate to 10% moving forwards, and you still will get something that some investors may argue as still a fairly attractive margin of safety, near the 15% point. Again, give us your thoughts on ASML. 37% upside is what Wall Street do expect. We then move on to Nike, which is down 37% over the last year. Year to date, down 23%. These tariffs haven't helped this company at all, and over the last 10 years, up only 14%. All-time highs quite some way away, around $180. At the moment, trading near their 52-week low with only a buy rating from Wall Street, and their forward valuation pretty much trading in line with the 5-year, and we do notice their yield at 2.73, one of the highest they have offered, significantly above the 5-year average at 1.13. In terms of this model though, we do in fact want to point out the expected price has been decreasing over time, not something you typically want to see with companies you've invested in or those you may be considering, but based on this model, we do again get another reasonable signal. And their growth, not only are we seeing an F here in terms of a grading, but year on year and in fact forward looking, it is negative, whilst the sector, even low, is still positive at the 2 to 3%, and they've been growing their revenue over the last 5 years at 5 and 6 respectively. EPS very poor, only 3% anticipated, sector a lot higher at 11, and their own 5-year even higher at 13%. They also only anticipate one of the next 4 quarters to be growth, with a 100% historical track record, and trading May 2026 numbers at a forward P of 28.31. That is above their forward P of May 2025, as they anticipate overall earnings per share to decrease. Again, something just to note. Now, intrinsic value at around $80, pretty much in line with Wall Street, who see this upside 36% over the next year. And in terms of a margin of safety, you are getting some in today's episode. In fact, as we keep on going, you're getting bang on a 25%, some that investors will argue is enough, but there are also quite a number of risks which have only increased with these tariff issues and tensions. But as always, let us know your own opinion. The next stock members of Congress have been adding is Merck & Co, down 35% over the last year. Year to date, down 16%. Over the last 10 years, up, although marginally at 37%. Another one like Nike trading towards the lower end of the 52-week range. And we also get a double buy from Seeking Alpha and Wall Street with a severe undervaluation signal, forward P of 9 below the average of 13, and their yield near the 4%, well above the 5-year at 3. And again, this is confirmed. All signals are pointing to Merck & Co severely undervalued. Growth doesn't look too bad at an A overall. Year-on-year revenue and forward looking around 4 to 5%, which does come in under the sector at 7 and 8, and also under their 5-year at 11 and 6. However, one thing that doesn't look too bad is their EPS projected 12.5%, above the sector at 10.5, but a little bit below their own historicals at 16.8, with 3 of the next 4 quarters anticipated to be growth to the EPS and a 100% historical track record. December 2026 forward P, unlike Nike, is actually expected to lower, something we'd expect for pretty much every stock, with a valuation anticipated of 8.5, and our intrinsic value comes to $118. There will be a lot in terms of a margin of safety given how hard this company has dropped. We're talking 30%. Wall Street themselves also anticipate $112 price target, 35% upside. Quite a lot of these stocks members of Congress are buying do seem to have a lot of projected upside by Wall Street, but we would be interested to hear your individual thoughts, at least for those that either you're considering to buy or have a strong opinion and do believe are a very massive red flag sell. The next one, which many investors have been adding in fact, is Amazon, up 3% over the last year. Year to date, down 13%. Over the last 10, still massive outperforming the S&P, up 776%. Trading in the mid to lower end of the 52-week range. Strong buy from Wall Street, a buy from Seeking Alpha, and trading at a forward P around the 30 to 31 mark. And they're also trading at one of the lowest EV to EBIT multiples in the last decade, as well as now trading at a lower forward P than Walmart, something that has caught a lot of attention from investors. And their growth looks very solid at an A-. Year on year, 10%. Expected the same moving forwards, well above the sector in the low single digit. However, they're increasing their revenue slower than the last 5 years at 19 and 17% respectively, with EPS looking strong, 19%, with the sector at 10.7. Bear in mind though, over the last 5 years, they've been increasing revenue and EPS at a faster rate. And out of the next 4 quarters, they anticipate 3 of them to be growth, with a 100% historical track record. December 2026 forward valuation anticipated 26.1. And our valuation of $230 today from the DCF model is based on a lower growth rate of 20%. Again, you can see the other growth rates, what they would entail in terms of value as well as upside. And you can grab a copy, as we said, of this model to run your own numbers, whether it's for Amazon or any others. But based on this estimation, we can in fact see you are getting near a 20% margin of safety. However, right now we would say 15 to 20%. Wall Street, very bullish. $254 price target, 34% upside. Maybe this is one you were buying just a few weeks ago when the share price was even lower. And this then takes us on to Adobe, another stock members of Congress, many of them have been adding, down 20% over the last year, and year to date down 14%. Over the last 10 years, up around 400%, and we can see one that has also been outperforming the S&P, trading near their 52-week low. A rare on the episode today, triple buy rating from every single analyst, and a forward P sitting at 18.7, and they're also now for the first time trading at a valuation lower than the S&P 500, and their growth, while coming in at a C, we can see is above the sector median, 10.5% over the last year, 10% moving forwards, sector pretty much in the mid-single digit, but over the last 5 years, they've been growing their revenue a little bit faster, 14.6 and 14% respectively, with EPS growth anticipated around 15%, slightly above the sector at 14, but also marginally below their historicals at 16, and always great to see this green right across the board, pretty much expecting double-digit growth to their EPS every single quarter, trading on November 26 numbers at a valuation of 16.7, and we can see our intrinsic value of $509 is derived by using the lower growth rate, one that we do believe you could also argue 10% to be appropriate, so we'll cover both of them. Firstly, at the 8% level, in terms of a margin of safety, you are getting a fairly large one for the company today, not at 30% just yet, you're getting bang on 25%. Wall Street themselves see this at $518, which does indicate 36% upside, but as we said, you could also argue 10% growth rate to be appropriate given their historical performance, and in terms of the margin of safety, no surprises, this will come to a larger amount. At 40%, 351, at 35%, that is where we see this in this moment in time. Give us your thoughts. It is one of those stocks that many investors are polarized. Some absolutely love it and the opportunity it gives today for the longer term, and others do believe this is one that will only go further and further lower with the AI disruption that they do anticipate Adobe will be unable to capture. We then move to Salesforce, which is up only 1% over the last year, year to date down 18%. Over the last 10, another stock outperforming the S&P up 280%, trading towards the lower end of the 52-week range. Double buy from Seeking Alpha and Wall Street, trading well below the historical forward P, 24.7 today, 5-year average 31.6, and that's also confirmed when we look at this model disparity between the 2 points. But again, we should make you aware that over the last year, the expected price has started to come down, and growth does come in at a C, but year-on-year revenue, 9%, as well as forward-looking, is slightly above the sector at 6 and 7% respectively. Bear in mind though, over the last 5 years, they've grown their revenue at a much faster rate. It has started to slow down, and quite significantly, 20 and 17% respectively on a historical basis. Earnings per share, 18% moving forwards. That is above the sector at 14, but slightly below their historicals of 20. And nice to see over the next 4 quarters, growth is expected. 75% historical track record. January 2027, trading at a forward valuation of 21.9, and our intrinsic price gets to $371. We have used the 12% growth rate moving forwards. We can also show you the lower rate and the margin of safety, but based on the medium at 10%, buy at 334. At 20%, 296. At 25, pretty much where we see this company. Wall Street, very, very bullish. $373 price target. 36% upside, and if we do go lower to the 10% growth rate moving forwards, you are still getting a margin of safety. How much? Well, that comes to around 15%, and as we said, one that Wall Street themselves do like a lot. We then move on to Advanced Micro Devices, one many members of Congress have been loading up. Bear in mind, they are due to report their earnings over the next few days, and we have done an in-depth deep dive on the company just yesterday, so check that out if you're interested. But they're down 32% over the last year, year to date down 18%. Over the last 10 years, massive outperformance of the S&P, up more than 4,000%. Trading near their 52-week low, massive pullback from 52-week highs of $188. Double buy from Seeking Alpha in Wall Street, and a forward P around 22-23. And it wasn't that long ago, in fact just a few weeks ago, where this was trading at one of the lowest earnings multiple in the last decade, with growth looking very strong at an A-, year-on-year revenue 14%, forward-looking 18.3, well above the sector at 6 and 7%, although we should point out over the last 5 years, they've been growing much faster, 34 and 26%. EPS though does look good, anticipated 28, well above the sector at 14, marginally lower than their 5-year at 32.8, with double digit expected over the next 4 quarters. Their next quarter, as we said, reporting earnings, they're expecting a 51% jump and a 100% historical track record, and if they hit that EPS for December 2026, they're trading at a forward valuation of 16.6. Now, intrinsic value of $137 is derived by using a growth rate of 25%, but we want to point out, for those that believe it should be lower, at 20%, it would give an intrinsic price pretty much in line with the market value. So if you are buying this company right now, already baked into the numbers is a 20% growth rate. But as we said, median rate of 25% will right now give a fairly attractive margin of safety. And as we keep on going today, you're getting near a 30% at $96. Wall Street, very bullish, $140 price target, 41% upside. AMD, is this one you have been buying, or in fact you do believe is a sell and will only go lower? We then move on to the Walt Disney Company, down 18% over the last year. Year to date, down 17%. Over the last 10, negative 16, so you would have lost money if you invested 10 years ago today. Trading towards the lower end of the 52-week range. Double buy from Seeking Alpha in Wall Street. Forward P of 17, well below their 5-year of 22.9. And another undervaluation signal given the disparity. So it does look like one that you could consider if you do believe the fundamentals over the longer term are strong. And even though we do get a D+ on the growth grade, we do notice year on year 4% revenue growth. Same as over the next 12 months anticipated. Little bit above the sector at the low single digit, but also a little bit below their own 5-year at 7 and 9%. EPS expected to grow 13% moving forwards, above the sector at 11, but well below their 5-year at 21.5, and only 2 of the next 4 quarters are expected growth, but we can see over the last year 100% track record. 2026 numbers, forward valuation 15.3, and our intrinsic value of $129 is derived from a growth rate of 10%. You can see at the lower rate we can again highlight the margin of safety, but there is still upside. At this level, in terms of an MOS, as in fact we do keep on going, at 30% is where we see this right now. Wall Street very bullish, $128 price target, 39% upside. In your opinion, is Disney one to consider? And as we said, at the 8%, you are still getting a margin of safety, clearly not as much as the higher future free cash flow growth. At 15% is pretty much where we see this today. We then end on the last stock members of Congress have been adding to their portfolio. Alphabet down 2% over the last year. Year to date, down 13%. Over the last 10, nice outperformance of the S&P, up around 500%. Trading near their 52-week low, double buy from Seeking Alpha in Wall Street, one that also trades below their 5-year average of 22.2, currently at 17.8, and another severe undervaluation signal given the disparity. And growth does look strong at a B, year on year 13%, forward looking at 12, well above the sector in the low single digit, but a little bit slower than how much they have been growing their revenue over the last 5 years at 17.5 and 15.4 respectively. EPS expected growth 16%, as we can see, sector low at 11, and also their own 5-year, although only marginally higher at 17.9. And we can see over the next 4 quarters, 3 of them expected to be growth, 100% historical track record, and we can see forward valuation 2026 16.1, and our intrinsic value of $226 is derived using a 12% growth rate. In terms of a margin of safety based on this number, as we do in fact keep on going today, you're not getting 30% just yet, sitting somewhere between 25 to 30%. Wall Street very bullish, $205 price target, 26% upside, and we can also finally show you at a 10% growth rate there is still a margin of safety, as in fact we do keep on going, not 20% just yet, sitting somewhere 15 to 20, and we'll even go one step further at a lower rate of 8% just to show you how severely undervalued this company is. While you're not getting a 10% MOS just yet, you are getting 5% at this lower rate, and as we highlighted, Wall Street fairly bullish, 26% upside. So in your opinion, are these stocks members of Congress been buying recently a good option for the portfolio, or maybe you have your own opinion which doesn't agree? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.